Good afternoon, everyone, and welcome. I'm Tammy Halevi, and on behalf of Reimagine Main Street, I am thrilled to welcome you to this important conversation, Finance and Equity, Insights from the Paycheck Protection Program. Reimagine Main Street is a multi-stakeholder, cross-sector initiative focused on advancing and uplifting policy and market solutions to ensure an equitable recovery on Main Street. In March of 2020, when shelter-in-place orders were first issued, we knew that Main Street's MLK Boulevards and Cesar Chavez Ways would be hit hard. So we assembled a broad and diverse group of stakeholders to share information and problem-solve responses. Over time, our initiative has evolved. We continue to host the network and also generate data-driven insights into the needs of diverse small businesses and their workers and host meetings like this one. This session is one in a regular series of events to engage policymakers, small business owners, and business system ecosystem participants across the country in dialogue. Today's conversation is critical and timely. We have known that from both empirical analysis and experience of small business owners in communities across the United States, that there's a market failure in small business lending. The Paycheck Protection Program, or the PPP, brought this problem into stark relief. And now, in the wake of the economic impact of the pandemic on Main Street and the racial wealth gap reckoning, addressing this problem has taken on a new sense of urgency. Although the likelihood is low that in our lifetimes we experience the need for another nearly $800 billion small business relief program, we believe that there are important lessons to be drawn from the program to improve lending for very small businesses and to entrepreneurs of color. Together with our partners at Aarp and the Federal Reserve Bank of New York, we have assembled an extraordinary group of senior government officials, lenders, analysts, and business owners to share their insights, experiences, and recommendations. There is much to discuss, so let's move into it. But first, two things to note. During the course of the conversation, please feel free to use the ask questions and chat functions. Our team will monitor the feed and do our best to provide your questions to the moderators. We are also live streaming this event via Facebook in addition to the Zoom, and the event is being recorded. It is now my great pleasure to welcome Susan Weinstock, Vice President for Financial Resilience Programming at Aarp, who has been a terrific partner in creating this event. Susan?
Thank you so much, Tammy. It's so great to be here. And hello and welcome to everyone. AARP is thrilled to be working once again with the New York Federal Reserve and Reimagine Main Street to study entrepreneurship and small business. I'm particularly excited about today's topic, that it's going to examine lending to small businesses under the Paycheck Protection Program. I personally feel like we've been living through a really interesting social experiment, and we're going to get to see how did these loans support small businesses throughout this really tough time during the pandemic. And we're going to get to see what worked. So let me kick this off by introducing Nancy Lamonde. I'm going to give a very short introduction, even though she has the world's longest title. She is AARP's Chief Advocacy Engagement Officer. And in that role, Nancy leads government affairs and legislative campaigns, public education, and volunteerism. She manages a team of 650 staff members and more than 17,000 volunteers from across all of the 50 states, the Washington, D.C. area, Puerto Rico, and the U.S. Virgin Islands. So with that, I'm going to turn it over to Nancy.
Well, thank you, Susan, and thanks to everyone for joining us today. I am so pleased to talk with Small Business Administrator Isabella Guzman, who took this position this past March. Administrator Guzman knows firsthand both the importance of small businesses in their communities and the challenges they face, since she herself grew up as the daughter of a small business owner. Administrator Guzman previously served as the director of the California Office of the Small Business Advocate, where she oversaw a network of small business centers focused on expanding assistance to underserved business groups. In this role, she launched new public-private partnerships and developed cutting-edge resources to small businesses in an effort to increase technology and e-commerce adoption. As AARP advocates for more accessible and affordable high-speed internet service across the country, we applaud successful initiatives like Get Digital California. Administrator Guzman has previously served in leadership at SBA as the agency's Deputy Chief of Staff and Senior Advisor during the Obama-Biden administration, where she oversaw policy and new program implementation. Now let me turn to the administrator to give opening remarks, and then I'll be pleased to talk with her about the SBA and the support of entrepreneurs and small businesses.
Thank you, Nancy, for that warm introduction, and I do look forward to partnering with you and AARP more at the SBA. Thanks also to Tammy and Susan for opening this important event. It is a pleasure to be here with AARP and the New York Fed, who are both key advocates in our efforts to increase funding for our nation's underserved entrepreneurs, women, people of color, veterans, rural and low moderate income communities, and startups. Nancy and the AARP have been longtime partners of the SBA, and I've seen them do so much really to help support our Encore entrepreneurs, who not only represent a sizable portion of the 30 million small businesses and innovative startups here in the US, but also are among the most successful. And I look forward to carrying some of my work from California on that front. I know you'll be hearing as well from Claire Kramer-Mills in a few moments, presenting New York Fed's latest data on the role technology played in the distribution of our PPP loans, and I'm looking forward to learning more from that presentation. New York Fed small business credit surveys are crucial tools that really help the SBA see how we're doing and identify gaps where we can plug in to better support our small businesses. And of course, Tammy, Renee, Rhett, just the Reimagine Main Street team has been exceptional in terms of supporting the SBA. So thank you for yet another great event and all you do to support our nation's small businesses. And most importantly, to any small business owners who are on the line here, I thank you for joining the conversation and learning about some of the people, the organizations, and the programs that are here to help you survive and thrive. You are giants in our economy, and my mission is to make sure that you're elevated and treated as such across SBA's programs and across the ecosystems. Today's topic really does hit at the heart of my top priority as SBA administrator, and it's true to my profession and my history as well, and that's ensuring that anyone from anywhere can achieve the American dream of business ownership. And we know that in order to start a business, survive and recover fully from COVID-19, take advantage of future growth opportunities, our businesses, especially underserved small businesses, need capital. While the SBA does have a vast array of programs and services to help gain access to capital, to markets and networks, those resources are only effective if they get into the hands of the small businesses that need them the most. So for our small businesses, connection to resources, especially through trusted partners and platforms, is really key. If we're going to bridge gaps that have stood between underserved entrepreneurs and opportunity for far too long, we do have to meet our small businesses where they are instead of waiting for them to come to us. That's our new mantra at the SBA. And technology is an important tool to helping us make those connections. Small businesses are increasingly using technology. Throughout the pandemic, many pivoted to sell their products online or reach customers virtually. And according to studies that I looked at during my time in California with Connected Counsel and Google, during COVID, 85% of small businesses said the pandemic made them rethink their approach to digital tools. And 3 in 4 said they increased their use of digital tools. And still more than half said that they plan to use even more post-COVID. So if the small businesses we serve are using technology, the SBA must pivot and adapt to find them where they're already doing businesses and serve them. We did this with the PPP, meeting them directly through their technology-enabled lenders in many cases, including some of our distinguished panel members today. And we're learning. We did this as well with the Restaurant Revitalization Program, which met them at their point of sale vendors, for example, including Square, that's on with us today, as well as Toast and Clover and Aloha. And we saw results on both of these programs. I'm proud to say that 2/3 of the 18 billion, so 2/3 of the 28.6 billion Restaurant Revitalization Fund went to women, veterans, and socially or economically disadvantaged businesses. And in PPP 2021, 96% went to businesses with 20 employees or less. with really strong performance in our rural and LMI communities. On PPP, our fintech partners helped us achieve that reach, and we invested in technology to make it easier for them to become a PPP lender, and we hope to continue to maintain those relationships beyond PPP. We need to build on those successes, and at the SBA, we must be technology forward in everything we do. And we are leveraging technology to help more of our smallest businesses get forgiveness for their PPP loans, for example. We will be launching an easy-to-use and streamlined PPP forgiveness portal to allow those with loans of less than $150,000, the majority of all borrowers on the PPP, to apply for forgiveness directly through the SBA. We're also improving the high-end demand COVID economic injury disaster loan, or EIDL, probably the worst acronym, which is a strong recovery tool as it provides low-cost, long-term funds with deferred payments. And we've delivered more than 3.8 million loans so far for $226 billion, plus, an availability of a grant program. So we've dispersed an additional $3.6 billion in companion grants through targeted EIDL and supplemental targeted EIDL for highly impacted small businesses in low-income communities. But we know we can do better and get these programs out all of our programs out more swiftly, and be more customer-centric in the process, along with being technology forward. That's how we're going to better achieve equity. And so we're modernizing our platform to create a more mobile-friendly experience and reach those underserved entrepreneurs through EIDL, who are increasingly relying on mobile technology. So at the SBA, we also carry, of course, the big responsibility of protecting the public trust. And so we're definitely creating mobile interface, but while continually aggressively weeding out fraud, waste, and abuse. All of this is just the beginning. We're just getting started, and we need to do much more. We know meeting small businesses where they are also means reaching those who are still stuck on the other side of the digital divide. And the Biden-Harris administration's Build Back Better agenda, as well as the bipartisan infrastructure framework, will ensure that every household in America has access to reliable, affordable broadband service. President Biden has made this the top priority. So now is the moment really to help our businesses get online, lean into those trends. But until that happens, we need to reach the small businesses without that access that need our help now. So sometimes this can be as simple as creating online videos that aren't so media rich, that they won't download over slow or unreliable connections, or finding ways for entrepreneurs without access to a printer or a scanner or good upload speeds to still apply for a program. Oftentimes it can be as complicated, though, as trying to help build those personal relationships with local lenders on the ground. And our CDFIs and MGIs and microlender partners are all crucial in this effort, as will be our community navigators, which we are launching soon, hopefully by September, along with our vast network of district offices and resource partners who will be on the ground offering free technical assistance, counseling, and more. Bottom line is that we do need to meet our small businesses where they are, as I said, and in order to do that, we must also understand their challenges and opportunities, but by looking at how they're operating today, so much has changed, their financial picture, and more. So across every program and service we offer, I've directed my staff to be as entrepreneurial as the entrepreneurs we serve and put our customer, America's small business, first, pivoting and adapting just as we've asked them to do over the past 19 months. This will help us, I believe, build bridges to those who have historically been left behind so that we can create a more equitable economy. We need to invest in these highly entrepreneurial communities to see our economy thrive. It'll benefit all of us. Strengthening our ecosystem for small businesses will better position us to ensure this next stage of recovery helps all our small businesses access the opportunities that will be available through the bipartisan infrastructure framework and President Biden's Build Back Better agenda broadly. Because as President Biden has said, we can't just return to where we were before the pandemic. We need to build our country and economy back better. America's small businesses are up to the task, but we need to transform our offerings to give them the tools so they can innovate and build and adapt. That's what they do, and that's what the entrepreneurial spirit is all about. And together we can bring businesses back, create jobs, and equitably connect all entrepreneurs in America to the support that they need. Let's get them to start and grow and be resilient. Nancy, look forward to our conversation.
Well, Thank you, Administrator. You've covered a lot of the terrain, and I do have a few questions that the planning group put together. You addressed many of these issues that I'm about to raise again, but this will give you an opportunity to reinforce your tremendous agenda. I think you know earlier this year, AARP collaborated with the New York Federal Reserve to examine the impact of COVID-19 on older entrepreneurs. A few of the pertinent findings were 80% of small business owners are over the age of 45. At the height of the first wave of COVID-19, more than 20% of small businesses shuttered, highest among age 45 and older business owners. And the number of active business owners aged 45 and older has fallen during COVID-19. The decline is particularly acute among people of color of that age. What do you see as the implications of this for the SBA as we turn the corner on the pandemic? And how is this going to change how the SBA supports older entrepreneurs and entrepreneurs of color in particular?
Yeah, I mean, I know that many of us have seen firsthand how so many of our small businesses were highly impacted. Of course, women and people of color, and as well, the entrepreneurs 50 plus who also have been impacted by COVID, both the pandemic and the economic impacts. Bottom line is that we can't see opportunity gaps widen any further, based on these historic inequities which led to the disparities during the pandemic. We can't see capital gaps widen further. And so, since the pandemic began, SBA has scaled dramatically from $40 billion to more than $1 trillion in relief during COVID, dispersing loans, grants, debt relief, and other resources to help our small businesses. And there is unprecedented attention right now on small businesses and on the SBA. So we need to leverage our private partners better to strengthen the SBA. And we need transformational change to drive economic growth. I mean, I see some of the comments for individuals who have tried to access relief from SBA in the past. And so clearly we need to make some significant changes. Some of it's statutory, so we need congressional partnership. And what we can do administratively, of course, we're trying to implement changes so that we can help small businesses. And everything is on the table. SBA is exploring direct lending on small dollar loans, increased partnerships for better distribution, venture and micro investment capital through our small business investment companies. And I think it's about design and implementation and outreach. So I'm proud as well that we launched the Council in Underserved Communities again, which I know AARP was a member of previously when it was launched during the Obama administration. That kind of early engagement from our stakeholders so that we can gain insights of what your members are dealing with, what small businesses are dealing with in your communities. That can help us better design these programs so that they're actually accessible, that businesses can use them. So we know that the capital is really critical as well, but we're also working really intently on the revenue side. Businesses want to do what they do best, which is to make that sale, make those revenues. And I think they'll always prefer revenue growth to a loan, get the contract, and just as much as a loan to fulfill it. So we do need to create opportunities equitably. And so we are looking to help small businesses better access the federal marketplace, to contract with the world's largest buyer. And President Biden recently announced an increase of our disadvantaged business goal to 15% over 5 years. And so that's potentially $100 billion impact over those 5 years. We know that it's a total solution for our small businesses. And if we want to build back better. So I do look forward to a lot of the benefits that will come out of the bipartisan infrastructure framework and the Build Back Better agenda of the president to invest in small businesses through some SBA programs that we're designing.
Well, thank you for that. And thank you for your long-term support, especially for older entrepreneurs, the fastest growing group, I think, of entrepreneurs. I always say that if I actually had a skill, I could become an entrepreneur and represent that older constituency. In any event, in February, President Biden announced a series of changes to the PPP intended to better serve businesses with fewer than 20 employees and the self-employed, who represent the vast majority of Black and Hispanic business owners of all ages. Under your leadership, the SBA significantly increased the mix of eligible and participating PPP lenders, leading to significantly higher loan volume and much smaller loans. You mentioned in your opening remarks a fair amount about technology, but I wanted to give you an opportunity to expand on that. What role do you see technology playing in better serving Black and Hispanic small business owners of all ages?
Mm-hmm, mm-hmm. Well, I mean, I think financial incentive to better leverage technology at scale across capital has been critical in PPP and demonstrated that it can work. And we appreciate that we have scaled from, on average over 1,000 lenders to over 5,000 lenders during PPP, and with more partnerships and connections for our diverse businesses to access our programs. That's half the battle, and is that connection and awareness early on many of these programs. So we hope to retain those lenders, of course, and also develop creative partnerships as we design new programs, with the bottom line of trying to make sure that our customers put first through the process, and that it's equitable access across our core programs or new programs. Women and people of color in particular have been left out of traditional financial systems. They're banking deserts affecting our underserved entrepreneurs. And so we do believe that technology can reach some of those deserts and allow for scale, especially with the infrastructure investments that the president is committed to making, to make sure that all the businesses can access technology and these platforms. So we will continue to look to fintech solutions and partners to better equitably serve regions and different underserved communities. But I think it's, beyond that, it's also internally adopting technology to streamline our systems. We've scaled dramatically in our portfolio, but not in the size of our employee base. And so we are trying to constantly look for, synergies across our programs and technology to, best practices from the private sector to continue to improve SBA's delivery of its programs, like the COVID EIDL. But I think what's important to note is, according to that same Connected Council and Google studies, that the digitally advanced small businesses, those who have adopted technology, voraciously, and like 10+ tools at least, they have a 50% better revenue performance than those who are uncertain about digital and don't adopt. They also hire 2 times more employees. And so those are, really profound data points for us to think about. It's not only just about connecting them with capital, but also, making sure that they're operationally better surviving and better to tap markets globally through e-commerce or outside of their local geography. So we are going to make sure that we are following some of the programs I put in California, making sure that we're connecting our small businesses to technologies so that they can take full benefit, from e-commerce in the future of markets overall, not just through COVID, but beyond. But we know we can't do away completely with human touch. So while we will be leaning into technology on capital and on all our programs and just in terms of how we train our businesses, we still know that we need to build back trust in many communities and make those authentic connections. So that's why partnerships with AARP and others is so important, because maybe it's your platform that's going to help us better connect authentically, or others in local communities. So we do look forward to expanding those partnerships through Community Navigator pilot program that was funded through American Rescue Plan.
Well, thank you. Again, you've touched on the subject of the next question. At the outset of the PPP program, 7A Lenders, the flagship federal loan program for small businesses, was designated as the distribution channel for PPP loans. And according to SBA, as of July 2nd, 2021, only 3% and 6% of 7A loans went to Black and Hispanic business owners, respectively. What are you focused on to increase the share of guaranteed loans to Black and Hispanic small business owners?
Yeah, clearly we must do better, and we also must continue to strive to collect better data as well. It's becoming increasingly challenging to get that data, as oftentimes it's voluntary. And so we'll for sure continue to try to be creative about collecting data so that we understand impact and can continue to improve. I know that equity has to be intentional. I was here serving previously. I know that we need to be, very prescriptive and committed to ensuring equity across our program design. That's from eligibility to use of funds to ease of use and turnaround times. And it's also in our selection of partners, not just our selected financial partners, 7A or 504 or microlenders or even our SBICs, but also our ecosystem partners who are on the ground, as I've mentioned. And it's also just in our implementation and outreach. One of the reasons why we did so well with the Restaurant Revitalization Fund, getting 2/3 of the funds into the hands of those underserved subgroups is because we increased awareness early on. We partnered extensively. I think we reached over 100,000 people through partners and webinars just to make sure that people were aware and felt comfortable applying. And we, of course, designed it simply and used technology too, but I think that outreach was really important. But in terms of immediate recovery and what we're trying to do, COVID EIDL is what's on the table as a key recovery product. As I said, low cost, long-term, deferred payments. We think it's a great tool to get more capital into the hands of our underserved entrepreneurs, and we're trying to leverage technology, to better distribute it and looking at just program policy overall so that we can get it into the hands of those businesses who did not access PPP or did not get enough PPP and still need money to survive. Because I think we have to recognize we're recovering, from the virus, but there's still risk. Businesses are still facing uncertainty and debt. And so we are looking to make significant changes to make that program more accessible to our underserved businesses, leveraging mobile technology, which they use at high rates, and just making some key changes. But the Build Back Better agenda broadly will be an important investment in small business lending and innovation, empowering the SBA to better reach underserved communities as well with some core program changes. So we're also really looking forward to those historic investments as part of President Biden's Build Back Better agenda. And so more to come on all of that as well.
Well, we're toward the end of our segment, and we have a lot of small business and entrepreneurs participating today. I wanted to see if you could tell them where they can go to be sure they know the full extent of SBA's programs and information services.
I really believe that small businesses need a team and that the SBA can be a critical part of that team. And so whether it's our local district offices, we have 68 district offices across the country, as well as we fund resource partners who offer free technical assistance like small business development centers, women's business centers, veterans business opportunity centers, and SCORE chapters. So all of that can be accessed through SBA.gov. So we encourage you to engage with us. We really are working hard to make sure that we are listening, that we're engaging with you, and that there's a new SBA evolving to really serve you. So we hope that everybody gives SBA.gov a chance and that you stay in touch.
Very well. Congratulations on your appointment, and congratulations also on obviously hitting the ground running.
Thank you so much. It's been my pleasure to be here. And I look forward to hearing your great panels, 2 panels that are coming up, many distinguished speakers. Thank you.
Great.
Thank you, Nancy and AARP, for your partnership and commitment to older entrepreneurs. And thank you, Administrator Guzman, for your leadership to ensure that, as you said, anyone from anywhere can achieve the American dream. And thank you both for being here with us today. I am now delighted to welcome Claire Kramer-Mills, the Assistant Vice President and Director of Community Development Analysis at the New York Fed, along with her colleague, Jessica Battisto, a Senior Analyst in the Community Development Department. They will share insights from their recent analysis that they published to better understand how different lenders performed in the PPP. Jessica, Claire, over to you.
Thanks so much, Tammy. And yes, we are going to share some key findings from research that we published recently with our colleagues, Asani Sarkar and Nathan Godin from the New York Fed. Before hopping in, I'll make the standard disclaimer that these views that we express today are our own and do not necessarily represent those of the Federal Reserve Bank of New York or the Federal Reserve System. It's hard to overstate the magnitude of the Paycheck Protection Program. Nearly 12 million loans totaling almost $800 billion were made in the span of 12 months. But beyond sheer loan volumes, the program was novel for expanding who became SBA authorized lenders. The program significantly increased the number of participating technology-enabled and community lenders, an expansion that small business advocates and experts argued was critical for ensuring broader and more equitable access to federal relief. Our research looks at the impact of these innovations, specifically the contributions of financial technology firms, which were active throughout all 3 waves of the PPP program. A quick note, community-based lenders played a critical role in PPP, often in collaboration with traditional lenders and fintech lenders. Our research yields 3 findings. First, we find that tech-enabled lenders, fintechs, as you'll see labeled in the charts, were material originators of PPP loans, originating roughly 20% of total PPP lending. Second, tech-enabled lenders served mostly new borrowers, which was different from banks which tended to serve previous customers. And third, tech-enabled lenders served large numbers of firms owned by persons of color and borrowers that had small dollar loan needs. So I'm going to turn over to Jessica to share more detailed findings. Jessica, over to you.
Thank you, Claire, and hello, everyone. I just want to underscore, the point that Claire mentioned about the unique contribution of fintech lenders, which you'll see is a through line in the slides that we'll be showing you. What we will ultimately present is that technology-enabled lenders were really critical to supplying small dollar PPP loans, and particularly to traditionally underserved borrowers. And we're drawing here on both supply side loan originations data and demand side business survey data to get a full view of the PPP program. So if we can move to the next slide, we'll get into that data. So first, it's important to point out that as more fintech lenders were approved as PPP lenders, their share of lending also increased. The first wave of loans were fully dispersed in April 2020, and fintech lenders were not authorized to originate these loans until late in this first wave. And because of that, you see a commensurately small share of loans made by them in these first 2 bars in this chart. Then in wave 2, which was late April through early August, the fintech loan share jumped 5 times higher, which you can see in these bottom 2 bars here. Now, we didn't include the numbers for banks in this chart, but it's important to note that during this time, the large bank lending share stayed pretty consistent between waves 1 and 2, while the small bank lending share dropped by nearly half. So this jump in fintech lending seemed to primarily eat into that small bank market. A few possible explanations for this. One is that fintech lenders appeal to small bank customers by providing a more efficient approval process. And that just likely outweighed the benefits of having a prior banking relationship as we move through the process. Also possible that underserved businesses like minority-owned businesses entered the PPP market in that second wave in greater numbers, or that small banks and CDFIs working with fintechs just made referrals to them. Next slide, please. So when we talk about this fintech expansion, we're really talking about a small dollar loan market. Fintech loans are shown in these charts by the red colored bands. And what you can see is that more than a quarter of loans under $25,000 were made by fintechs in wave 2. And to orient you, I'm looking at the right-hand chart, that leftmost column. But as you get into the larger size loans moving right on that chart, the fintech loan share decreases, which is not the case for bank loans. And we'll get into this in a couple more slides, but our findings indicate that this difference is a result of self-selection on the part of the borrower rather than a restriction imposed by the fintech lender. Next slide. Great. Fintechs were also really good at bringing in new customers. Maybe back one. There we go. What this chart is showing you here is the share of each lender's applicants that had an existing relationship with that lender. And you can see that the vast majority of bank applicants had already worked with their bank prior to the pandemic, which was clearly very helpful for bank customers. But on the other hand, 2/3 of fintech applicants were actually working with that fintech for the first time during the PPP process. Going a little further, we also looked into the characteristics of these fintech applicants, and we found that these were businesses that were less likely to have banking relationships and who had difficulty accessing credit. So fintechs really seem to open up the program to a different set of businesses. And to talk more about that, I will now pass it back to Claire.
Thanks so much, Jessica. We can go to the next slide, please. So this chart shows the frequency of PPP loan requests made to different lenders, broken down by the race and ethnicity of applicants. And what you can see is that if you look at the second two sets of bars, banks were the most frequent lenders that borrowers turned to, as Jessica had indicated earlier, irrespective of race and ethnicity. But I'd like to orient your attention to the top set of bars. As you can see there, fintechs attracted notable applications from Black-owned firms, roughly 1 in 4 applicants. And that's the red bar that you see at the top. Now, our data show that applicants who sought PPP loans from fintech lenders were more likely to lack banking relationships, be minority owned, and have fewer employees. And so these are really, in many cases, some of the smallest businesses that really were less likely to have participated in wave 1 and did participate in greater frequency in waves 2 and 3 of the program. We turn to the next slide, please. You see on this page is the median PPP loan amounts that borrowers requested, as collected in the Fed's annual Small Business Credit Survey. And this is pretty novel data in the sense that it really shows borrower requests, which is unique. This isn't data that's widely available, and it's information that we were able to tap into through the survey that we field annually. The differences that you see here between loan requests made to different lenders is pretty striking. You see that the fintech requests were less than half on average than those made to small and large banks. And it underscores the point that fintechs were really serving small dollar needs and small dollar requests. The median amount of PPP funds sought by fintech borrowers was $32,000 compared to about $60,000 for bank applicants. We can turn to the last slide, please. Thank you. One other note on the application that I'd like to make is that fintech lenders approve loans with a median size of $20,000, while banks approve loans with a median size of about $50,000. So both the requests were smaller, tended to be smaller at fintechs, and commensurate with that, the loans that they issued were smaller as well. So to conclude, turning back to the question that we posed at the top of this presentation, what impact did the innovations that were made during the course of PPP, what impact did they have? And our evidence shows that technology-enabled lenders did expand access in profound ways to federal relief. Fintechs and community-based lenders were more likely to serve borrowers who would not have received loans otherwise, especially Black business owners and borrowers seeking smaller dollar loans. Now, this is not to say that the program reached all borrowers in need, and I'm very much looking forward to hearing insights from both borrowers and lenders in the following panels who participated in PPP and can share insights about how we can build on this program to expand capital access further. So back over to you, Tammy. Thanks.
Thank you, Claire, and thank you, Jessica, for setting the stage for the next 2 panel conversations. As always, your data and insights set the standard for understanding small business needs. The data is telling, and it raises a lot of interesting questions. Fortunately, we've assembled a group of people who are perfectly positioned to make lots of additional meaning from your analysis. It is now my great pleasure to welcome to the virtual stage Usman Ahmed, the head of global public policy at PayPal, Erica Khalili, the general counsel of Square Financial Services, small business owner Carmen Tapio, she's the CEO of North End Teleservices, LLC in Omaha, Nebraska, Luz Urisha, the president and CEO of Accion Opportunity Fund, and Grady Hedgesbeth, the assistant director for small business lending markets at the CFPB, who will moderate this esteemed panel. Grady, over to you.
Thank you very much, Tammy, and thank you all for joining us today. What a great panel, and what a fantastic address by the SBA administrator and all the things that SBA is doing to try and reach small businesses. And what wonderful analysis that the Federal Reserve Bank of New York has done with this PPP data, which gives us, I think, probably our best picture of the effectiveness of fintech lenders in reaching the hardest to reach of our small business customers, those that are minority-owned, women-owned, and those who are located in very distressed areas. So we have a panel that's going to give us a little bit of insight into how this whole process works with technology. But first, let's start with a business that actually had to go through the PPP process, and it was also minority-owned. And in this particular case, in introducing Carmen Tapio, it wasn't just your typical smaller business, but I'll let her tell her story. Carmen, I'll turn it over to you.
Thank you, Grady, and thank you. It's really an honor to be here today. I'd personally like to thank the moderators, the panelists, and the other speakers, our hosts, AARP, Reimagine Main Street, and the Federal Reserve Bank, as well as Administrator Guzman. My company, North End Teleservices, is an outsourced contact center provider, and we have a mission of creating jobs and changing lives. We are also a HubZone certified business, and today we employ over 400 people. Our company is made up of wonderful people from our community, but 80% of them are minorities. It's important for me to tell this story because while we feel the impact of every small business that went out of business during COVID, because in many cases they didn't receive PPP funding, there were also families and communities that were impacted and that suffered directly as well. I was fortunate ultimately to have my loan processed, but it was not without challenges. When I applied for PPP funding, and I stayed abreast of everything that was happening and read all of the guidance that was being put out and tried to mentor other businesses through the process, I was ultimately declined by 5 very large banks in our community that said that they would not be processing my loan because they were going to process their large customers first and those that had an existing line of credit. These are the same banks that would not extend a line of credit to me in previous years when I needed it. So you can see the catch-22 that came from not having a line of credit in the first place, and then large customers with large lines of credit or existing relationships being processed first. And I would just mention that included the bank that I had an existing relationship with for 5 years since I started my business now almost 6 years ago. The banks believed that they wouldn't make any money on small businesses, and so they focused on the large. Ultimately, because I have access and through relationships, I was able to contact a community bank that processed my loan, and I was one of the first 2 that this bank processed. And they told me that the key to their success in processing PPP was that most of their employees had access to the SBA portal, and that they also relied on old-fashioned paper on the front end prepare the loan packages, and that created more throughput capacity, although they ultimately had to enter the data. It's very possible that if we did not receive our PPP, our business would have suffered and potentially gone out of business. Instead, the PPP helped us to weather the storm called COVID and answer the call of our state later in the year in responding to COVID in providing contact center support for unemployment claims and other benefits on behalf of the citizens of the state of Nebraska. We weathered the storm to ultimately grow in the 4th quarter of last year, and today we are on the Inc. 5000 list of the fastest growing private companies in America with over 400 employees. And our economic impact today is over $70 million. So again, it's important for me to tell that story so that our lenders understand that when they're declining these loans, it's not just the business that they're impacting, it's already disenfranchised people and communities as well. There are people behind these stories. Grady, I think you might be on mute.
Oh my goodness, I said I was not going to make a mistake in front of a national audience, but hey, this is those times, aren't they? That's an incredible story. And especially because in spite of your size and in spite of your track record, you needed a high touch lender, that community bank, in order to process your loan. Imagine if you had been much, much smaller.
That's right.
And that, I think, is a good segue to our next panelist, and that's Usman Ahmed. He is from PayPal, and PayPal, in case you have not made an online purchase, is probably one of the payment options you find as a consumer trying to navigate online purchasing. that's very, very relevant and prevalent in the marketplace. And PayPal had already gotten into the small business lending area, but I really would love for you to tell us a little bit about that story and what the PPP program meant for you in terms of how you're thinking about small business lending.
No, thanks so much, Grady, and thanks to the organizers of this event, and thanks to SBA for putting the entire PPP program together. Yeah, so as you mentioned, we launched our PayPal Working Capital product, small business lending product in 2013, and automated service that uses that payments data you talked about in partnership with a bank to underwrite credit for small businesses. Incredibly successful program. And so when the PPP came around, we had never done an SBA loan before, but we were seeing through our payments data just this obviously massive fall off in commerce, frankly, as everybody remembers from March and April of 2020. And so we were just scrambling to try to do whatever we could to help. We were already doing a number of relief programs internally for businesses that were on our platform. And then once we learned about PPP, and as Claire described, fintechs were allowed into the program, we were among the first. And it was just an incredible sprint. And again, credit to SBA, they did an amazing job. Obviously, we can talk about technology and modernization, and I think the administrator talked about some of those things about how we can improve it. But just briefly, we were able to do about 115,000 of these PPP loans. I think over 420,000 jobs that were implicated, and had many of the same findings that Claire described. Very, very small loan amounts, newer businesses that were sole props, were having difficulty finding financing elsewhere. We had, as I mentioned, because of a tech company, an online system, but because of PPP, we also had a lot of manual intervention. We hired a lot of people to really help with this process to make sure the businesses understood it and were being, given proper customer service as you were walking through. The last thing I'll just mention that I think is really interesting from a fintech and PPP perspective is Claire Kramer-Mills, who presented before, had another paper actually on the PPP program that talked about how Black businesses were shut out of the initial phases of PPP. And so we actually used her research where she looked at the 30 counties in America with the highest density of Black businesses. She showed that the overall PPP program was disproportionately missing those counties and missing the businesses in those counties. And we basically replicated that, and we're super happy to show that actually the online, in particular PayPal's loans, were disproportionately going to those places. So just a really, really nice example of being able to fill a gap. And I think partnering with a bank, and enabling those kinds of loans was really an incredible experience. And then I'll just leave with, we would love to explore additional ways to engage in public-private partnership around an inclusive recovery. I think that's really the next phase we're moving into and what we're really thinking about. Thanks so much.
So filling that gap has been tremendously important because unfortunately, the reduction in the number of smaller community banks that service those markets. And it's a trend that I think, unfortunately, is going to continue, which is a very good segue to our next panelist, and that's Erica Khalili. I live in Washington near Eastern Market, if anyone's ever visited the city. And I'm in our farmers market, the oldest one in the country, every weekend. And it has a great flea market associated with it. And everyone's got a square that they're swiping those payments on. And I do a lot of just informal survey, and about 80% of those vendors got a PPP loan. I think that's a really, really good story that they were able to get one, but most of their needs were very, very small dollars. So can you tell us, Erica, what the PPP program did for Square? Because you were already in the small business lending business, but did it change your perspective or the volumes that you were doing in that area?
Yeah, thank you so much, Grady. First, let me give my profound apologies to the group. I apparently have lost video. The joys of this remote, especially as I'm here positing the influence and the impact that technology can have, and yet I've failed once again to utilize technology in the most elegant manner. To your point, Square's business model is really focused around economic empowerment and empowering the smallest of the small businesses. Similar to what Guzman was saying, our average loan size with respect to PPP was around $15,000, which was a loan level that you weren't seeing more traditional and larger financial institutions serving. And really what drove us towards the PPP program was hearing from our sellers and hearing it day in and day out at the outset of the program that they were frustrated, they were confused, and they were looking for ways to also take somewhat opaque concepts as it came from PPP and distill them down into really a usable manner where they could quickly submit an application and receive funding. And that was where Square saw that we already had these existing relationships with, as Guzman was saying, the sole proprietors, the independent contractors, the really, bread and butter of the economy in terms of the smallest of the small businesses. And we had built systems with many of these sellers to allow them, a very seamless application process where we had data on them already. We knew these folks, we knew their businesses, and were able to really utilize two vectors that I think were really impactful for how technology-enabled lending supported the PPP program, which is the speed with which we were able to sort of jump into this new business area with the SBA in partnership that we were not in before, but also the ability to get to scale quite quickly. We were able to facilitate in the first round to over 80,000 small businesses. And that was something that was really, really impactful to our seller community who, were going through what was an unprecedented time, and we're going to other financial institutions and looking for more engagement, more calls back, things of that nature, and weren't having it. And so the ways that we could utilize our technology and our existing platforms to make that a really seamless, elegant, and fast experience is where we absolutely double clicked. And we, again, dovetailing off what Guzman was saying, this was a program where we saw so much value and so much gratitude from our sellers. And it's something that we continue to look for ways where we can continue to partner with the SBA.
Excellent. Let me ask you, if you would, do you find any difference in the ability of your vendors who get a Square loan or got a PPP loan and the volume of their receipts? Have you done any studies in that area, if it makes a difference?
Yeah, we have. We actually have seen growth from the sellers that take out a Square Capital loan. And then in the PPP, we've been watching sort of having the access to their real-time processing data lets us understand and know kind of how their business is coming back from unprecedented times and be able to right size tooling and support for them as they're coming out of the pandemic and actually growing in many cases. One thing that I think, at Square we've seen that is what motivates us the most is we've also seen the resiliency of our sellers. We've seen them shift into online sales and delivery services and making sure that we're continuously iterating and getting that feedback loop and building tools and services that help them to shift as these unprecedented circumstances, but also as we sort of get to the new normal. That's where we're really focused right now. And I think that we've seen our lending program in the ordinary course, and we've definitely seen PPP be a support system for these sellers to, run and in many cases grow their businesses even in spite of the pandemic.
Oh, excellent.
Grady, I'd just love to chime in on that because we actually studied that exact thing. Sorry, and we did it in the height of the pandemic in April and May of 2020, and what we saw was businesses on our platform that didn't take the PPP loan, their sales went down 15%, and the ones that did went up 15%. So it was just incredibly, correlated with impact on revenue. So I think you're spot on in asking that question.
Well, thank you for chiming in because I was going to turn to you because I thought you might have some insight into that since that's your primary business, to help your businesses grow, to help your vendors grow. Lucia, from Acción Opportunity Fund now. It's always good to see you, a longtime collaborator, and Acción Opportunity Fund has been doing this small business in the CDFI space for a very, very, very long time, and now has partnered with FinTech. So I think you were in a really great position to talk about the promises, but also some of the concerns perhaps that we should have as FinTech lenders get into the space, because you know how much assistance sometimes is needed for these very small businesses to access credit appropriately.
Sure. So thank you very much for arranging this panel and to Administrator Guzman for the opportunity and your remarks. I think the crisis kind of helped us do things that we had not done before in the industry, things that were very positive. It promoted and allowed the development of partnerships and innovative programs to help fill capital void for the small business struggling the most. I know we partner with a number of organizations. First, when we were not able to provide PPP because we were not authorized, we partnered with CDC to use their platform. And then once we became an authorized lender, then we brought others along that were not part of lending under PPP so that we can help their customers. But I think one of the things that we did see is that, the partnerships that were created as a result of PPP not reaching the communities that need it the most. We see those partnerships having tremendous potential and the ability to reshape the lending landscape for small businesses going forward. Not only are these structures and these partnerships and funds unlocking some incredible impact, but I'm also really heartened to see how many CDFIs are partnering with other CDFIs and with fintechs, which before, we may have considered each other competitors, but we're now working together side by side to scale the impact collectively, many, many multiples beyond what we might be able to do by ourselves. So this is incredible. And I'm going to take it, the conversation a little bit in a different direction in terms of giving you some context. But as I said, when we realized that PPP was not reaching the communities that needed this funding the most, many of us recognized that CDFIs were going to be an integral part of the economic first responders, and that we needed significant increase in resources to support the communities in need. So since early in the pandemic, there have been 4 or 5 funds that have been launched in different parts of the country to provide low interest loans and free business support to small businesses and the holistic resources that CDFIs and potentially down the road, right, fintechs can need, such an integrated customer acquisition platform, the liquidity to lend, risk mitigation, other support services. All of this really has allowed all of us to lean in to this crisis and help with the relief and long-term recovery. And for, the small businesses on the line today, these funds are operating in 18 or 19 states. Administrator Guzman was very instrumental in helping us launch the California Rebuilding Fund when she was in California. Our organization, Acción Opportunity Fund, in collaboration with 9 CDFIs, banks, corporations, philanthropists, attorneys, and many others, we were part of setting the California Rebuilding Fund, which really is a private and public sector partnership that's bringing funds together from different sources, including an anchor commitment from iBank, the State of California Economic Development Bank. Another partnership that it's available in 15 states on the Southeast, also providing low-cost capital and business technical advice, is the Southern Opportunity and Resilience Fund. And it's 15 states working with small businesses and nonprofits. There are other funds. There's one in California, one in Illinois, one launching in Washington. And, there has been an ability to bring CDFIs together, which were really, as I mentioned, the economic first responders. So I do believe that this crisis is not going to waste altogether because we are now seeing how the ecosystem is collaborating and working together, more cohesively. I will say, though, that what worries me is that this rebuilding phase from the pandemic is going to take a long and difficult journey. And it's going to need a lot of capital and a lot of resources and many, many constituents working together. And if we learned anything coming out of the Great Recession, it will be extremely uneven unless we intentionally build our resources and the support and the infrastructure that works for all small businesses, especially the businesses and populations that were left behind. I am thankful, as I look at the American Rescue Plan, I see that it now gives cities around the country more financial autonomy than PPP did to leverage the resources from federal and state funding to help stabilize small businesses and catalyze economic recovery. But it's also important to understand, Grady, that all businesses are not created equal. And while millions of businesses have been decimated, there are millions of businesses that are doing well. And so different businesses need different interventions, and having cities and local entities that can serve as brokers to connect small businesses with loan capital, grants, equity, coaching, support networks, community infrastructure building like incubators and accelerators, I think are really critical to help in this recovery. And also supporting small businesses at scale is really important. And it's going to require significant investing by CDFIs in particular to leverage technology and data analytics, and implementing, the customer service that is appropriate for the target market they're serving. And Administrator Guzman mentioned this. Many small businesses are very comfortable accessing capital and resources online, but some are not. And they're not ready to self-serve yet. And so a combination of helping people through the process, a digital experience, but having somebody that they can engage with one-on-one, I think it's going to be very important. And last but not least, I think we all know that the financial services sector, not everybody is providing quality products. Many financial services providers are not held accountable for building financial health in small businesses. And this is a problem that we need to solve in small businesses. Whatever you do, make sure that you're understanding what the terms of your loans are, because there are a lot of products out there that are wreaking havoc on businesses. And I know everybody right now is looking for capital, and it needs to be healthy capital. Look at the Small Business Borrower Bill of Rights, which is a set of guidelines that lenders should follow when providing capital. It's responsible lending. And last but not least, Grady, Section 1071, we need to collect data of who's lending, at what cost, and what products. And we also should strive to implement a federal Truth in Lending Act for small businesses, which does not exist today.
That's an incredible amount of wonderful information. And I'm especially heartened by your shout out for the CDFI community. You've been doing this work in connecting to the hardest to reach borrowers for more than 4 decades. And one of the biggest constraints I know for that industry to respond to PPP was both having access as well as having the capital to support an expansion of your balance sheet. So good thing that that has started to happen. So Tammy, I am going to turn it back over to you. And thank you all for participating in this panel.
Wow, I wish that conversation could have continued for a lot longer, as there is so much to think about, and clearly you all just scratched the surface. Thank you very much, Grady, and to the panelists. I have more confidence in the prospects of the future, knowing that you all are working hard to meet the needs of small business owners. So thank you, Usman, Erica, Carmen, Luz, and Grady. So financing in relatively small dollar amounts is one problem that technology can powerfully contribute to addressing, as we've heard. At the same time, there's a separate but not unrelated problem of increasing SBA lending to Black and Latinx business owners. And honestly, we could not ask for a better group than our next panel to identify and recommend specific ways to increase SBA lending. We have a mix of banks and loan funds, traditional CDFIs and fintech CDFIs. All of these lenders have track records of distinction serving Black and Latinx underserved small businesses. I am now delighted to welcome Annie Donovan. She is currently the Executive Vice President and COO for LISC. She's also formerly the Director of the CDFI Fund and a visionary in the space. Sean Salas, the co-founder and CEO of Camino Financial, a CDFI that uses proprietary AI to extend affordable credit to underserved Latinx entrepreneurs. Robert Villarreal, who is the Chief External Affairs Officer for CDC Small Business Finance, a leading CDFI loan fund and SBA lender, who Luz mentioned their platform. And Darren Williams, the CEO of Southern Bancorp, headquartered in Arkansas, which includes 3 CDFIs, a bank holding company, a bank, and a nonprofit loan fund. And finally, David Clooney, the inaugural executive director of Black Economic Alliance, who will moderate this terrific conversation. David, over to you.
Thank you, Tammy, and thank you all for putting together this great conversation. It's been really informative so far. Really appreciated the comments from Administrator Guzman and all the other speakers who have shared a lot of interesting knowledge. And I think it was said earlier, and it's exactly right, that the last 18 months have been a bit of a real-time social experiment. And I think one of the things we're going to start talking about in this conversation, and I hope we continue the conversation after this and continue to implement action after this, is about what we learned from this process, particularly about reaching communities most in need. And we think a lot about the name of this panel, increasing SBA lending to Black and Hispanic owned businesses. And really the goals for this panel that we're trying to achieve are just identify and discuss the actions that the SBA took and other agencies where relevant that could materially increase lending to Black and Latinx owned small businesses. And we think about, I think we learned particularly in the first tranche of the 3 waves of the Paycheck Protection Program, some of the flaws in the broader challenges in the 7A lending reach. So we'll use PPP as a bit of a helpful jumping off point for a conversation about addressing flaws and inequities in the current configuration of the 7A program and really the infrastructure of the SBA distribution system in thinking about how we better reach Black and Latinx owned businesses. So with that, I'll jump into the first question, which is, I will start, it's a bit of a 2-part question. So I'll start by addressing the first part to Robert and then the second part to Darren with a little bit from Annie in between. So, thinking about, Robert, your organization has done a lot of direct lending, but you're also a high volume 7A lender. And PPP is built off the infrastructure of the 7A loan program, like we talked about. And particularly in the early rounds of the PPP program, the existing SBA loan infrastructure was not as effective reaching and serving Black and Latinx borrowers compared to their white and Asian counterparts. What lessons did you draw from that experience, and what changes would you recommend now that we are able to look at this very recent history to the 7A distribution channels to better reach Black and Hispanic business owners?
Great. Thanks for the question, David. I really appreciate it. And thanks to Administrator Guzman and the SBA for all the great work they've been doing over the last several months. So first, we learned that it took continued outreach and support. So we held daily webinars right from the start, particularly during the first 2 rounds last year, to assist the applicants, educate them on the process, and walk them through the real nuances of the submittal process, particularly when there was, lots of changes coming out, sometimes on a weekly basis on the program. And then it took working with a multitude of community partners, many outside of the lending industry. Luce talked about the partnership that we had, that CDC Small Business Finance and Acción Opportunity Fund had. But we also had your almost non-traditional partners. We worked with the U.S. Hispanic Chamber of Commerce. We worked with the National Association Latino Community Asset Builders. And then a real unique partnership that we had was with a company or a website set up by Sean Combs, also known as P. Diddy, who set up a website called Our Fair Share. And in fact, 70% of the loans that we did that came from Our Fair Share were to Black-owned businesses. So it took some creative and innovative thinking, and we're fortunate to be paired up with him. In regards to changes, there's one change that could be done very quickly. And we did it actually after PPP ended, the first 2 rounds. SBA launched a program called CARL, Community Advantage, I think, Recovery Loan. And they waived a referral fee. Historically, the SBA says you cannot make the referral fee to a partner contingent on funding. Not a lot of people are going to pay you up front for just a name and a number. So under CARL, they waived that, and we were able to work with community partners in that way. So if that could be waived, I think that would be a help. And then the other recommendation would be, you've got this great infrastructure of community advantage lenders, which is a set part of the 7A program to do loans to 250. The top 7 or 10, out of the top 10 CDFIs, I think 7 or 8 are community advantage lenders that did the PPP. So you've got this great infrastructure of 100+ lenders already that know how to get into the community. Use those and have conversations with those because I think we can help the SBA get to where they want to get to.
Yeah, that's absolutely right. And I'll put a pin in that because I want to come back to Annie for her CDFI expertise and talk about CDFIs in more detail. But let me go to Darren next and ask, so Darren, your institution originated PPP loans in all 3 rounds. And I know our organization, the Black Economic Alliance, was advocating particularly during and after the first round for changes out of the SBA and the administration to basically create more opportunities for small and very small businesses, but particularly Black and Latinx businesses where there's a lot of overlap between the two, to have access to PPP loans, particularly those who did not have banking relationships. So in the SBA 7A program, the federal government guarantees up to 85% of loans originated by private lenders. If one of the challenges in lending to Black and Latinx communities is collateral and perceived risk, do you think increasing the federal guarantee, perhaps from 85 to something like 95%, would make a material difference in lending to Black and Latinx owned small businesses? And what other changes might help improve eligibility for more Black and Latinx businesses?
Well, David, first of all, thanks for the question, and to the sponsors of this important conversation, thank you for inviting me and Southern Bancorp to participate. Yes, I do think that increasing the guarantee to 95% could have a material change. With the current increase to 90%, we've seen an increase in our SBA lending now. In fact, we've done about $6 million more dollars in SBA lending through half of this year as we did all of last year. And I think part of that increase really is because of this 90% guarantee. And I can think of 2 or 3 examples right offhand that we probably would not have done that loan, but for that 90% guarantee. So I think that would be an important change. But the collateral challenge is true for Black and brown lenders, but it's true for all lenders. And so increasing that guarantee will be a stimulus for the financial institutions making the loan. But if you want to help the borrowers who are actually the minority-owned businesses to access this loan, it's that 10% equity injection that becomes the biggest barrier for Black and brown businesses to take advantage of that of the SBA program, particularly the 7A program. And so one recommendation we would have would maybe to create a tiered equity injection process. So smaller loans might need less equity. So say instead of 10%, maybe 5%, or maybe no equity at all injection. That would help. We also think maybe you could structure that to where that equity injection may relate to the available liquidity that borrower might have. So maybe 50% of the liquid assets on hand. That could be a way to change that. The other thing is that the equity injection has to come from if it's a land, it has to come, or property, it has to come from property related to that project. So what we might suggest is, for example, if that borrower has equity in property that's not related to that business, maybe you could use that equity as part of the equity injection, because that land can't be used for equity injection, but the SBA would require us to take that land as collateral for the loan. So we really think it's that 10% equity injection that really is preventing many Black and brown businesses from really accessing. And again, I think a number of examples of folks that we would like to make loans to, but they couldn't come up with that 10% equity injection. And that's really holding back, maybe even more so than the amount of the guarantee, which is really about the bank. If you really want to help the minority-owned business reduce that guarantee, or really tie it to something that makes it a little more easier for that borrower.
Appreciate that. So I want to turn to Annie now and extend the question of what can be done to increase access for Black and Latinx businesses in changing the criteria for SBA lending, but with a specific focus on your expertise in community development financial institutions. You wear 3 hats as the Chief Operating Officer of LISC, one of the largest CDFIs in the country, your former role as head of the CDFI fund at Treasury, and your role on the board of City First Bank, which is both, and correct me if I'm wrong, a for-profit commercial bank, but also a CDFI, which is kind of rare. So interested in your perspective on, we heard in the last panel, in the previous panel, a number of examples of partnerships among different institutions that touch small businesses and kind of at different points of entry to plug into the SBA distribution channel. And I know we, again, at BEA, were advocating for increased access and even set-asides for the CDFI community as a means to get more access and more resources to Black and Latinx businesses. So interested in your perspective on the role of CDFIs in SBA lending.
Sure. Well, thank you so much, David. It's great to be here with you. Appreciate the opportunity. So yeah, I have a couple different points of view on this. And let me just say, first of all, from my perspective at LISC, that we did originate PPP loans. And when we first of all had to go out and raise liquidity. So the first thing that was apparent is that, the natural flow of capital through the PPP program, when it was set up to mirror 7A, didn't get to the communities that we care about most. And partly for us, it was a matter of lining up the liquidity. So that took us a minute. And then I think that the SBA started to see Luz talked about CDFIs as the economic first responders in crisis. And we keep proving that again and again. And I think the data shows how CDFIs performed through this crisis is very, very clear that we have established ourselves as the economic first responders. And so I think setting, to the degree that we can get that understood and CDFIs can be made part of the default thinking when a crisis hits. When there's a disaster, for example, the federal government has a pecking order. They first send money out to FEMA, and then they send it out to the small business lending program, and there's certain channels. And I think that that we've proven that we should be baked into solutions from the get-go. And let's take the lessons from this crisis and build it in so that we're ready for the next one. But I also want to say that the important thing here is, and you've heard this echoed, that what CDFIs do is also work through a network. CDFIs are certified not just because of our lending, but because of our development services as well. So we pair development services with lending, and that's part of the magic. And I think the SBA has recognized that in creating the Community Navigators program, because we have to be thinking about, and Robert touched on this too, we have to be thinking about the network effect and the ecosystems that we're building locally to support small businesses, not just with lending, but with the other kind of technical assistance and networks and business development opportunities that are needed as well. And so I also just want to pick up on a point about, not all small businesses being ready to use the internet to do all of their business. We did a lot of hand-holding with our PPP borrowers. We went out through our grassroots network, and many of the customers just said to us, "Thank you so much for helping me navigate through this. We could not have gotten access to this without that support." So I think that's really, really important.
Appreciate that. And I think that's a good segue to bring Sean into the conversation. Sean, there's been a lot of talk in this panel and the previous panel about, and throughout this program, about the role of, and I like using the term tech-enabled lenders instead of fintech to make it more inclusive. And you are the head of and founder of a neo-CDFI that uses proprietary artificial intelligence, Camino Financial, that uses proprietary intelligence, artificial intelligence rather, to extend affordable credit to underserved Latinx entrepreneurs. And currently Camino does not participate in SBA guaranteed lending programs. And we heard Administrator Guzman talk about the SBA wants to increase partnerships with and participation by tech-enabled lenders like Camino in SBA's activities. And then also we saw the New York Fed analysis found that tech-enabled lenders brought in a larger amount of new borrowers, particularly Black and Latinx borrowers who had not previously engaged with SBA programs. So wondering if you can answer kind of both why Camino is not an SBA lender currently, and more importantly, what would need to change for Camino and more tech-enabled lenders like Camino to participate and hopefully reach more businesses in underserved communities.
Yeah, absolutely. It's a pleasure to be here. On the question of why not, I think that's a fairly simple answer. Until last year, even using the word fintech was still, a bad word in many different circles. And I think that was a function of the disruptive nature of fintech, but also in the process, some false steps that were made. But we also saw in 2020 how vital fintechs and tech-enabled lenders were into making capital more inclusive. And I think that's been able to bridge the opportunity for leaders like Administrator Guzman to make it very intentional to bring fintechs and tech-enabled lenders into the tent of SBA as a sustainable and ongoing part of the solution, not a one and done opportunity in PPP. And quite frankly, that dynamic simply just didn't exist. The second part of that answer, and this now segues a little bit into the solution, but I think it's important that we distinguish established fintechs versus emerging fintechs. As we think about established fintechs, we've been seeing the innovation happening, really booming since 2008 as a product of the Great Recession. And what we found is that fintechs have a place here. A lot of them are now very large, multi-billion-dollar companies, moving anywhere between up to $4 billion in loans per year and growing. And the reality is that for these established fintechs, they're already pretty much in the tent. In fact, Lending Club is now a top 50 SBA lender, and they're making their way into the tent through the back door and the front door. The back door through M&A, in the case of Lending Club, which is now a top 50 SBA lender under the 7A program, but also through the front door. Something that we didn't really see coming was now fintechs want to be regulated entities like Square, OnDeck, and Varo, and even using the word neobanks as one to extend services beyond credit. And I would predict that of that top 50 list, that in the next 10 years, you're going to see anywhere between around a third of all lenders being tech-enabled, fintechs moving over 50% of the volume. And I'd assume the remaining lenders being very tech-enabled and moving the remainder part. So that disruption is already happening. I think where the opportunity is for emerging fintechs who are increasingly more focused on Black and Latinx markets. They're moving over the course of their lifetime probably less than $100 million, but they're going from 100 to $1 billion very quickly. Like in the case of Camino Financial, we're actually going to hit our $100 million mark within a few days. And so I want to highlight how can we work with emerging fintechs. I want to draw attention to one case study that we learned in PPP, because I know we've been saying we're going to use PPP as a case study, where Blue Acorn and Préstamos, which is a CDFI, they partnered to move PPP funding. Through this partnership, they moved close to 500,000 PPP loans, totaling $7.7 billion in 2021. That's 500,000 loans totaling $7.7 billion in 2021. I need to repeat that, because that's over 50% of the allocation towards CDFIs. And I think there were four parts of this partnership that made it work. One, the use of technology. Two, integrating a tech partner with the CDFI. I think that community-driven approach that Annie was referring to is critical. We say at Camino, capital in isolation is not the solution. Three is simplifying the application and design of any program for solopreneurs. Simpler and smaller is better, and it aggregates to a lot of volume, and that's where the biggest need is. And last but not least, update the incentive structure, which happened under the Biden administration, to make these smaller loans more profitable for the lenders. At the end of the day, profit does move money, and the more that we can revisit those incentive structures, then absolutely, I think there's a big opportunity. And so I'm very bullish about fintechs and their role in SBA programs under the current administration.
Appreciate that context, and congratulations on approaching the $100 million mark, and look forward to you continuing to grow. So in the interest of time, I will start to wrap up, and there were two questions I wanted to ask to the entire panel, so I'll kind of combine them and ask you to do a part one and part two answer. And Annie, we'll go ladies first, and I'll start with you. Part one is, what would be your single most important message for Administrator Guzman to increase SBA lending to Black and Latinx borrowers? And then part two is, there's a lot of congressional staff on the line, and what would be your single most important message for Congress to increase lending to Black and Latinx borrowers through SBA programs and otherwise?
I would say understand the importance of community-based ecosystems and support them. And I would say, in addition to that, let's increase the guarantee amount up to 95%.
Appreciate that. Darren, question to you. Same question. What is your most important message to the SBA, most important message to Congress?
Sure. Thanks, David. I guess I would again echo the fact that it's that equity injection of 10% that's keeping out many minority-owned borrowers from participating in the program. So let's look at tiering that system that will maybe mirror the size of the loan. It would also increase the guarantee. But again, the city as a CDFI, particularly operating in rural community, while tech enabled is very important, particularly in rural communities where sometimes there's lack of access to broadband. It's very, very important that our CDFIs are part of the solution because we are completely engaged with and a part of the communities that we serve.
Appreciate that. Sean, we'll go to you next. Message to the SBA and message to Congress.
Yeah, I'll cheat. I'll do 2 messages to the SBA and 1 to Congress. To the SBA, revisit the Community Advantage Program, create a 2.0. I know it's coming due to its expiration date next year, and use it as an opportunity to open the tent, and simpler and smaller is always better. The other one, which Administrator Guzman already mentioned, but just want to reinforce it, invest in your own infrastructure so you can support this growing ecosystem. I think that's really important. And then to Congress, revisit regulation to smaller banks. Regulation can, while helpful, can also hamper liquidity into smaller businesses. So to think about that thematically.
David, can I make one comment about the Community Advantage Program? I just want to make an addendum to what Sean just said. Absolutely 100% on the Community Advantage Program 2.0. But I know that it's been a pilot program, and there was a study, and I don't know if the study was released publicly, but it examined loss rates among CDFIs versus other types of lenders. In order to really understand the performance, you have to have an impact analysis of that as well. So if there's a difference in who CDFIs are serving, and to what degree does that explain any difference in how they're performing in the program? And that is really, really important. So if you start from the question of how do we reach Black and brown entrepreneurs, and then look at that reach and see who's getting there. And I don't think it's apples to apples when you compare just any old 7A lender who is not having the same reach as CDFIs. So I would just urge you to, I don't know what the state of that conversation is, but I would urge you to look at that.
That's a great call out. I appreciate that, Annie. So Robert, we'll go to you to close us out.
Yeah, great. Thank you. And I appreciate that comment, Annie. And Senator Cardin right now in the Senate has a bill to make it permanent, but it's a great conversation to have. And I think it's something we need to continue to have. So I'll end it so it could be a little bit controversial, and maybe people want to continue the conversation. But while I don't want to alienate my colleagues, and an increased guarantee is always better, but really at the end of the day, to me, that benefits us, the lenders. Really what the focus should be on is how do we transform the products so that they are more responsive to the Black and Latinx communities? You know, Darren gave an example. There's a heavy reliance on SBA, on our personal credit score that drives the SBA score. How do we go beyond that? So we really take into consideration kind of historic disparities and the systemic injustice. So how can the SBA do that? And for Congress, how can they be supportive of that and allowing some of those changes, and to really push the SBA in being a solver for bridging the racial wealth gap?
I appreciate that, Robert. And this has been a great conversation, really just scratching the surface in this 25 minutes we had for the discussion, but a great discussion. And I will say I've been impressed with the perspective and engagement from the administration and a number of folks on the Hill in Congress on this issue over the last, since the new administration has been in place and with the current leadership in Congress. So I think there's a lot more we can do. We're continuing to learn, but great conversation. Thank you all for all the work you do serving these communities and making sure that resources are getting to the places they're most needed. So I will kick the program back over to Tammy. Thank you to all the panelists. And I'm sorry, actually, I'm kicking it over to Rhett to close us out.
Awesome. Well, thank you so much, David. Thank you to this amazing set of panelists and quite frankly, just the whole amazing set of people who've joined us today to share your amazing insights. We know how busy everyone who joined us today is. So the fact that you took an hour and a half out of your time to share your insights and move forward this conversation with us, I'm personally grateful. I know the whole Reimagine Main Street team, the AARP team, and of course the team at the New York Fed is grateful. I just wanted to take a few moments to wrap up a little bit about what we heard. I probably will not do the best job Just a huge thanks, obviously, to Administrator Guzman for taking time to join us, and Nancy Lamonde from the AARP team. And I think what we heard in their conversation was, we're fortunate to have a partner at the SBA, and that the SBA is hearing that access to capital is important for small business owners, particularly to issues around reducing inequities, which I think is so important to everyone who's part of this conversation. We know at this moment that they're working to modernize customer interfaces, to move technology forward, and to improve customer service. I think many of us who've been working in this space are excited that there's a focus on technology and see a lot of opportunity for potential partnership with the government. We heard from the New York Fed team about their amazing research. Thank you to Claire and Jessica for being a part of the conversation. And I think what we really heard from them was, while fintech and technology-enabled lenders originally had a small share of the PPP loans, we saw that this grew rapidly as time went on, and that they really did have an interesting outside impact in delivering resources to business owners of color that generally wouldn't have had access to be able to receive funding. And as we think about how to create more equitable lending ecosystems, the data tells us that there's some interesting solutions that may lie in there that we can learn from that. We heard from an amazing panel led by Grady at the CFPB, and we heard from them about how technology-enabled lenders were able to see data that showed borrowers of color were having more difficulty accessing PPP loans, how their tech focus allowed them to learn quickly from the data, adjust quickly with partnership across the industry, and deliver a better product for those who needed it. And finally, in our last panel, moderated by the amazing David Clooney from BEA, we heard a discussion around originating small denomination loans that uncovered both problems and potential solutions for underserved communities. I think what we heard was technology alone isn't going to fix this problem. It's exciting, but we also know that we have to be able to meet small business owners where they are, and particularly business owners of color, especially Black and Latino-owned businesses. We heard from raising federally backed guarantees to mitigate risk for lenders, utilizing the expertise of CDFIs, that there's steps that we can take as a community to do more to really meet this community where they are. Finally, I just want to say a huge thank you. This event would not be possible without the hard work of our amazing partners, both the whole AARP team, Susan, Jean, Felicia, some of which you didn't even see today on the screen, but doing amazing work to make all this happen. And of course, the Federal Reserve Bank of New York, Claire and Jessica and their team, which have been such stalwarts of making sure that we have the research and the data that we need to be able to tell the story, to inform the public policy solutions that are so important in this moment as we all seek to build back better from COVID-19. And finally, I would be remiss if I didn't thank my amazing team, Tammy, Colin, Abdullah, Jared, and many other folks who worked so hard to just make today's event a success. And finally, I want to close out with some resources. There are so many amazing resources for small business owners. We want to encourage you to check out. AARP has a fabulous center for the 50+ entrepreneur at smallbizrcrc for resourcecenter.org. You can check out the New York Fed, and of course, we heard the administrator point us to sba.gov. With that, one final thanks to all of you for giving us an hour and a half of your time. I saw that we had over 400 people stay the vast majority of the time, which is an amazing turnout for this event. Thank you all so much for being here. And with that, this now concludes our program. Have a great day, everyone. Bye-bye.